Hello, welcome back to Learn Economia. Today we are going to discuss the risk and uncertainty in economics. Let's have a detailed look onto the same here. When it comes to both risk as well as uncertainty, we could find that these play a very important part when it comes to the decision making. So whenever you make certain decision today, which will be having some influence on your future, we could find that these decisions are being influenced by both risk as well as uncertainty. So, for the same reasons, your behavior will be something that plays a very important role when it comes to making decisions regarding risk as well as uncertainty. So, this is something that is applicable to individuals or people. Your personal level decisions, your job based decisions, etc., would be coming under this context. Again, businesses or firms will also come under this because firms would also be making certain decisions regarding their future production, future market prospects, and so on. Also, of course, policymakers would be making some decisions regarding something called future policies. Future policies. Because whatever decision that we take today will be having some impact on our future, isn't it? So, whether it is individuals or business or policy makers, they are very much concerned about this. And for the same reason, they know that there is something called risk and uncertainty that would be surrounding their decisions. So we are moving on to the detailed explanation of risk and uncertainty concepts here. Coming to risk. Risk involves a scenario where the outcome of a particular decision could be quantified. So what you can do is that the outcome can be explained in terms of a particular number. Okay, so how can this be possible? This is possible by considering something called probability. When we consider the idea of probability, we look on to the likelihood of occurrence of an event. So it's all about likelihood. So we just see whether a particular scenario is having a more chance of occurrence or less chance of occurrence. So when you look at when you look outside, you will be saying like this, okay, today it might be raining, or it might be raining today. So you might be thinking like this, oh, majority of the chances to rain today. So there is less chance to have no rain, more chance to have rain today. So this is how you will be making certain kinds of predictions, isn't it? So it's certain kinds of possibility that you are considering with some available information. This is the same thing that we have to consider when you have a risky situation. So you consider the expected probability scenario, or else you go for estimation of probability, and coming to the risk element, the probabilities of different outcomes. So this will be norm. Okay, so based on this probability, you will be going for something called expected returns. Expected returns. Once you have probability, you will be calculating your expected returns based on the probability. So this is how you calculate risk. This is how you arrive at a numerical value with respect to risk. Okay. Now, let's have some examples of risk. Just think about a scenario when you invest in some stock market. When you invest in some stock market, you know that it's something very risky, isn't it? Because there is something called fluctuations. So price can either move up or it can come down. So you might be getting sometimes profit, and sometimes it can be a chance of loss also. So this is what is actually creating a risky scenario. The situation of having a loss will be making us to consider stock market as a risky venture. Again, just talk about a business decision. So when you make a business decision, sometimes some element of loss might be there. So when there is some element of loss, you think that okay, there is some risk involved, because there is something called the trade unions and all, they are functioning in this way, that way, and so on, or else there is some policy challenge that is happening. So you think that there can be a certain risk involved in our day-to-day decisions. So in the day-to-day decision, in the individual level, in the day-to-day decision of a firm level, as well as the day-to-day decision of a government level. So here we consider the likelihood of all the outcomes of an event. So we consider an event, and this event will be having different possibilities. So just consider tossing of a coin. So when you toss a coin, this is called an event, and it can have various possibilities. For example, it can actually give you head, or else it can give you tail, isn't it? So what is the chance of occurring a head? You know that 1 by 2 is the probability of getting a head, and coming to tail, that 2 is 1 by 2, isn't it? So like that, for every event there exists some possibility or probability associated with every outcome. So this head and tail would be identified as outcome of this event called tossing a coin. Okay, so this is something which is very important to consider. And when you look at the real life instances or real life situations, you could find that this risk element could be assessed by using some already existing data. Here comes the role of historical data. Here comes the role of statistical analysis. So you can have some kind of forecasting. You can actually use something called already existing data, already available data. So based on this, you will be arriving at some decision. So that decision too is not accurate because you know it very well that there is a chance of risk involved. Okay. Now let me take you to the different types of risk preferences. How would people prefer this risk? Whether they accept it or whether they reject it. If they are rejecting it, to what extent? If they are accepting it, to what extent? So this is what we can have. So when we look onto the preferences of risk by people, we could find maybe 3 categories of people, or we could actually group people into 3 groups or 3 categories. So one group in that would be the risk averse category. So risk averse category will be those people who hate risk. So they are afraid of risk. Okay, these people are very much afraid of risk. They are very much fearful about risk. And for the same reason, what these people would be doing is that whenever they are given 2 situations, or whenever they are given 2 outcomes, just assume that one outcome is having some expected utility, and the other outcome is also having same expected utility. So in that scenario, they will see which outcome is certain. Certain means it happens for sure. Okay, certain outcome means something which happens for sure. Uncertain means you do not have any surety. No surety element is happening. It's not sure. Okay, so you will just see which is sure and which one is not sure. So as far as a risk averse person is concerned, he will be having a tendency to prefer that sure outcome or certain outcome over the uncertain outcome or not sure outcome. Though both these outcomes are having the same expected utility, the risk averse person will be going for only the sure or the certain outcome because he is very afraid of risk. He hates risk. So he always has got a tendency to avoid all the risky situations. That is the main reason he will be, that is the main reason why this person is going after the certain outcome or sure outcome. Okay. Now, coming to the next category of people, these people are always indifferent between the sure outcome and unsure outcome. So they are always indifferent between sure outcome and non-sure outcome. Why this is happening? Because these people are called as risk neutral people. They do not usually distinguish between these sure outcome and unsure outcome or not sure outcome, because they think that both are having the same expected utility. So why should I actually distinguish between these two things? So for the same reason, these people would be very much indifferent when they are given 2 outcomes, one certain one and the other one uncertain one, because they think that both are having the same expected utility. So they go as indifferent between these 2 outcomes. Okay. Now the next category. So these people are very rare. They are called the risk seeking individuals. So they are also called the risk lovers. risk lovers. They love to have risk. So they always, for the same reason, would go for that non-sure outcome. Non-sure outcome. So they think that this would be the better one. So let's have some adventurous scenarios. Let us involve in some kind of adventure. So this is the kind of thinking mentality of these category of people. So for the same reason, they will be preferring that non-sure outcome, even if they find that the expected utility of this not sure outcome is lesser than that of the sure outcomes or certain outcomes. Okay, so they always think like this. So whenever I take high risk, this will be giving me a high return. High risk, high return. So this is what they think. So if I take high risk, I'll be getting high return. If I take low risk, I'll be getting only low return. So why should I actually avoid my high return? Or can't I go after my high return? So to have this high return, definitely I should go for high risk. So for the same reason, let me go for the high risk. This is the thinking perspective of these people, the risk seeking category or the risk lovers. So for the same reason, they will be involving in such kind of risky ventures like gambling. They will be very much interested in involving in gambling, and also they will be investing in highly volatile stocks. So they might be knowing that these stocks are very much fluctuating. So even after knowing that this is very much fluctuating, they will invest in this because they think that if it is moving up, definitely I'll be getting a high return. So why should I avoid that? I do not want to have that opportunity cost. So I will go for that high return, high risk combination. So this is the thinking perspective of risk seeking individuals, which are very rare in our world. Okay. Now let me go take you to the graphical explanation regarding the risky situation, the risk preferences of different people. So here we are going on to see how we will be able to look onto the three categories: the risk averse, the risk neutral, and the risk seeking individuals. So for this, what you do is that for every curve, you are measuring the potential payoff along the x-axis. So this would be the x-axis in every curve, and you will be measuring the utility along the y-axis of every curve. Okay, so you can have this risk preference scenario or the utility curve for every individual, every category of individual. So if you look at the first curve, as you could find, this is the curve for the risk averse people. So it means that the curve is actually having a tendency to have a downward kind of movement, isn't it? So it curves downward, and you could find that as the potential payoff increases. So just assume that. So you can take different points. Let it be from here to here. So what happens? The curve is actually sloping downward, isn't it? So it will be having a tendency to come like this, isn't it? So for the same reason, you could find that these people are actually willing to give up some potential gain to avoid the potential loss. Or else you could find that increase in utility from a small gain is not as great as the decrease in utility from a small loss. So this is the scenario of risk averse people who actually hate risk. They are afraid of risk. Now coming to the next category called the risk neutral people. So what is happening with respect to the shape of their curve? So this here is something that you can have a concave shape. This is concave shape, this one. And coming to the risk neutral scenario, this is a linear kind of context. Their utility curve would be linear because these people are very much indifferent between the risky situation and non-risky situation with the same expected payoff. So these people are neither attracted nor averse towards the risk. That is why you could have a linear curve over here. Okay. Now coming to the next category, which is the risk lovers or the risk seeking category. So we could find that this curve is actually a convex looking curve. It means that the curve will be actually moving upward. It curves upward. as a potential payoff increases. So these people who belong to the risk seeking category, they would be willing to accept a potential loss for a chance of a larger gain. So this is why they are always willing to take up the risk. You could find that increase in utility from a larger gain is actually much greater for these people than the decrease in utility from a small loss. Okay, so this is the main reason why these people are having a tendency to move like this whenever there is a scenario of increasing potential payoff. So again, you could consider 2 points in these curves and these curves, this curve. So you can have a comparison here. Okay, so here it is linear, here it is concave, and here it is convex. When it comes to the types of risk preferences. Now, after understanding the risk preferences, now we need to see how to manage the risk. Management of risk will help us to reduce risk to a great extent. Reduce risk to a great extent. The first thing that you have to do here is that you need to assess the probabilities which is connected to different outcomes. So different scenarios or different outcomes will be giving different probability, isn't it? So just have a calculation of the same by having proper data. So you will be having already available data. Just use that data and arrive at some probability calculation. Now you can go for some proper kind of expected valuation, and you can see what is the possibility of some outcome, actual scenario. What is the expectations or expected loss or expected gain that you will be able to get from a particular outcome. So you can go for that and you can arrive at a particular decision. Now, the next thing that you can do is that you can diversify your portfolio. So what about it? All about diversifying portfolio. So rather than putting all your money in stocks, which is a risky venture, what you do is that you will be putting your money in different assets. You will go for stocks, you will go for fixed deposit, you will go for real estate, you will go for some precious metals, estate, real estate, then you will go for some precious metals like gold and all. So it will thus way act as a combination. Okay, it will act as a combination. So gold, investing in gold is again having some risky elements, but when you diversify your portfolio, what happens is that if the stock market is down, you will be able to compensate with your FD. If the real estate market is dull, you might be able to compensate it with the gold. So some asset might be having a less valuation in the market, whereas other assets would be having a higher valuation. So what you can do is that you can compensate your loss in certain assets with the gain that you get from the other assets. That is it all about diversifying the portfolios. Now the next thing what you can do here is that you can go for insurance. So when you go for insurance, what you automatically do is that you will be shifting the risk, isn't it? So when you actually take insurance from an insurance company, you are not having the issue of taking up the risk. Instead, what you do is that you would be shifting the risk to the company. So that too will be that too can be done. So insurance will be making you to pay a premium, which appears to be a cost to the insurance, but still many people do this to avoid the risk. The next thing that you can do is that you can go for hedging techniques. So it is a risk management strategy, which will be helping you to offset your loss. So especially this will be happening in the scenario of investments by taking an opposite position in a related asset. Okay, so this is yet another scenario that you can adopt, or yet another management technique, risk management technique that you can adopt to deal with the potential losses that you will be getting if there is more risk involved in your activity. Having discussed too much regarding the risk, let us have a detailed discussion on to what is called uncertainty. When you consider uncertainty, it's all about unpredictability. You won't be able to predict what will happen tomorrow or what will happen in the next moment. It's all about some unpredictability scenario. Okay, an unpredictable scenario. So what happens is that you consider the probabilities of different outcomes, but you could find that as a result of looking at this probabilities of different outcomes, you could find that these are unknown. So you won't be able to calculate probability. So this cannot be calculated. Unknown means cannot be calculated, or else it would be very difficult to calculate, isn't it? So you cannot in that scenario have a numerical value. Numerical value is impossible. Numerical value in the scenario of uncertainty is impossible. It's an impossibility, because you don't have enough information regarding the outcomes that will be occurring, because it can happen anytime, any scenario. For example, just think about a natural disaster. You won't be able to predict it, isn't it? So sometimes you might be saying that, okay, there is a chance for this to happen, but you cannot predict its exact time of occurrence, isn't it? So this is something uncertainty. Again, you can talk about technological innovation. When you go for innovation, you won't be able to say whether there is a profit or loss. So there can be equal chance of profit or loss. But again, you won't be able to say that it is actually equal. In certain scenarios, it might not be equal. Sometimes actually there would be a loss scenario for you after implementation. Again, political developments. The government might not be able to predict what will actually happen when there is a project implementation. Again, you cannot predict this natural disasters occurrences. It can come and actually destroy a complete land. It can actually create a barren land into a flood situation. It can actually transform a drought prone area into a water lodged area, isn't it? So it's all about something called unpredictability. These can happen. Now, how would you be able to manage the uncertainty? So one thing that you can do is that you can actually collect as much as data as possible. Data collection can be done. So once you collect as much as data as possible, this will be to some extent enabling you to go for the calculation of risk. And also you can consider something called scenario planning. So just take the situation and analyze it from various perspectives. So you need to have multi-dimensional approach in this case. And also what you can do is that you can build some flexibility into the decision. So you need to see what will happen if it is a yes, what will happen if it is a no. So if it is a yes, what should I do? If it is a no, what should I do? So this kind of flexibility should be incorporated into your decision making. And you need to understand that it's very important to develop some robust kind of systems to make yourself flexible to adopt the changes. And also it's very important to be very much prepared for the unexpected occurrences, because these preparedness will be helping you to make adaptations very quickly. So this will be a response kind of thing that you will be doing here. You will be responding quickly to the changing circumstances. So that too will be one important thing that you can do to manage the uncertainty. So it is not in your hand, it is something that is uncontrollable. So what would be the economic implications regarding risk as well as uncertainty? We could find that both these are related, right? Both these are related to a great extent. So both these will be influencing the decisions that we will make in the arena of investment. So we have to be very cautious in our each and every step. So whenever we take a behavior, whenever we go for a step, we need to see what can be the implications, what can be the possibilities. So try to gain more data and then act. Gain more data and then act. Okay. So if you see that it's not a good environment to make investment, you can wait for some time. Just delay your investment decisions, and after finding that you are able to understand the market behavior, you can make investment. Otherwise, what happens is that if you are not aware of the market and if you are making investment, you might be having a huge loss. And also when it comes to policy aspects, always go for something called flexible approach. So rigidity always harm. So say bye bye to rigidity. So rigid kind of thing will lead to some very high level of risk. So you should be always ready to adjust to the policies, and also policies too should be adjusted, because the world is changing, the environment is changing, the economy is changing, the society is changing, the political structure of the world is changing. So what you have to do is that you need to incorporate the new information into your decisions, so that it's all about adaptability, isn't it? So this too can be made possible. Also, whenever you go for some business decisions, always adopt some strategies. So there should be some proper methods that you should go for, and in these methods you need to ensure that you go for proper planning, because as I was telling you, everything is subject to change and everything is still changing, and you need to ensure that the decisions that you make today is actually incorporating the situations of the market that is prevailing right now. So this is very important to stay competitive and resilient in the market. So this is something that will equip you to be in the market. Otherwise, what happens is that there can be a scenario of loss and it will make you to exit the market. So this can be prevented if you try to be competitive by having certain proper planning, by incorporating the newly changed scenario of the market. So planning is very important. Now, what you can do is that you can analyze the decisions of your rivals also. Okay, so analyzing means you collect more data, and this more data can be related to not only the market scenario but also the decisions and the practices, the behavior of your rivals. So that will make you much more competent in the market when it comes to especially something called firm-based or business-based decisions. And this decision making process itself should be based on some proper planning. And this proper planning should happen with something called flexibility. Flexibility should be there. Okay, so then only you can have a kind of economies of scale in your decision making. Otherwise, definitely it will be turning out to be diseconomies of scale. So overall functioning of the market and economies will be something that is influenced by risk and uncertainty. Definitely. So for the same reason, whenever we make a decision as an individual or a business or a government, it's very important to consider all these matters. So that is it all about today. You can actually download the Learn Economy app to get previous year question papers and answers, free study materials, live as well as recorded classes, and free MCQ based weekly tests. So I'll be providing the link of the same in the description box. Also, you can join our free Telegram community, for which also I'll be providing the link in the description box. That is all about today. You can like, share and subscribe to our channel for more such videos. Thank you for watching.